Good morning and welcome to Charting the Markets on Friday, the 21st of April. Now, today we've got a plethora of flash PMI data out, and we saw so earlier today in Japan when we saw that manufacturing PMI rose to a 6-month high, and that was followed by French and German PMI data also being very strong, where we saw business activity in both countries growing to a 12-month high, and the German composite PMI rising to 53.9 in April, versus an expected 52.6%, similar to the French one. And both basically pointed to the fastest expansion in private sector and services activity in a year. But at the same time, we had manufacturing PMI data shrinking in Germany for a 10th straight month, and factory activity in France contracting to a 3-year low. Now, the data, therefore, was slightly mixed, and if you look ahead to the US, we can see that at 2:45 p.m. later on today, we expect US PMIs to come out for the month of April, and there we also expect manufacturing to fall to 51.4 and services PMI to weaken to 51.8. Now, earlier today, we also saw worse than expected UK retail sales data for the month of March, which came in at 0.9% versus a downward revised 1.1%, that is 1.1% positive for the month of February, and an expected 0.5% for the month of March. But retail sales did come in at minus 0.9%. And basically, despite that, if we look at the daily chart of the FTSE 100, you can see here that we actually have risen now above this week's high that was made on Tuesday at 7,919 on the daily financial bet, and are gearing up to head up towards the psychological 8,000 mark. And ahead of there, we've also got the early March high at 7,976, which is our next short-term upside target, ahead of the psychological 8,000 mark, and then ahead of the February high at 8,044. From a technical perspective, even though we've gone sideways over the last few days, basically, as long as we stay above the last reaction low, that is to say the low seen on Wednesday at 7,872, provided we remain above there, the upside is still very much intact, and we expect further upside to be seen with regards to the FTSE 100. Moving on to the European markets, you can see here the DAX 40 contract is heading higher. It's actually coming off, unlike the FTSE 100, which is heading higher. And here we made a low at 15,703 earlier today on that German PMI data, but seem to be recovering slowly at the moment. And the decline we saw over the last few days was on the back of Wall Street, also heading down again on mixed earnings in the US, and also on new recession fears. And as both the Cleveland Fed President Loretta Mester and the Philadelphia Fed Bank President Patrick Harper wish to see the rates in the US for the Fed funds to rise above 5% in order to combat inflation. And Mester also expected a recession to be seen in the US later this year, but expects it to be to turn into a soft landing, basically. But both of these Fed members who are now talking ahead of the blackout period, that hawkish view that they are talking about basically has pushed equity markets lower in the US and also dragged down some European markets, such as the DAX 40. Now, for the DAX to resume its uptrend, it would have to rise above this week's high at 15,903, in which case it could then be heading back up again towards the psychological 16,000 mark. And then above there, we've got the high seen back in August of 2021 at 16,032. So these are our short-term upside targets. And given the strength of the upside we've seen over the last few weeks with regards to the DAX 40, unless something fundamentally changes to a large degree, I wouldn't be surprised if we were to have buyers enter this dip again and push us higher over the next few days and weeks. And from a technical perspective, provided we stay above the last important reaction low, and that is to say the low from the 5th of April at 15,480 on this daily financial bet, provided we stay above there, for me, the odds are still pointing towards higher prices to be seen with regards to the DAX 40 over the coming weeks. Now, moving on to the Dow Jones Industrial Average, and here we can look at the Dow, and what I find really interesting, and that's why I love technical analysis, is that once again, we have failed exactly where we as technical analysts will expect it to have failed, and that is to say we had the December to February downtrend line, which came in at 34,133 on this daily financial bet, and it is exactly where the Dow was capped on Tuesday of this week. And since then, we've seen so far 3 consecutive days of lower prices with regards to the Dow, and are also overnight in line with the European markets trying to recover off these lows. But if we were to slide later on today, we may find support around the 4th of April high at 33,690, and then below that we've also got pretty good support at the March high at 33,577. And here, from a technical perspective, for me, as long as we stay above the 10th of April low at 33,332, this low here, I believe we are still in an uptrend, and that we could eventually take out this previous downtrend line and head back up again towards the February high at 34,516. So short term, yes, we're seeing a minor reversal, but as you can see here, we are seeing it with relatively little volatility. So we're sort of keeling over very slightly, which seems to be an indication that we are just consolidating the previous uptrend, which has been quite strong. So we'll have to see whether further upside is likely with regards to the Dow. I believe it is, and buying the dips at the moment, for me at least, looks to be still the best strategy with regards to equity indices. The US dollar has continued to appreciate over the last few days, with the dollar index rising off its one-year low earlier this week, and this trend continuing in the short term as this idea of the Fed having to hike its rates further and keep them at elevated levels for longer gains traction. So if you look at the euro-dollar chart, for example, where the euro is making up 57.6% of the US dollar basket, we can see here that the inverse has happened, that we've come off this 110.75 high, a level last traded back in April and March of last year, and that we have been trading in a sideways range since then around the 109.50 area. And we can see here that further sideways trading is currently taking shape, and we'll have to see whether we will fall next week, perhaps below this week's low at 109.10, because if that were to be the case, and to me it looks likely that this will be the case, then we could head back down again towards the 108.32 April low, and also that's the April 10th low, and the 107.80 of April low, which together with the high seen in mid-February at 108.04 acts as pretty good support. So we've got a pretty strong support area between 108.32 and 107.89, which may be revisited next week if we were to fall through 109.10. Short-term resistance can be seen around the early April highs at 109.73, and between it and the psychological 110 mark, and above there we also have pretty good resistance around the February high at 110.33. But to me, this sideways trading pattern is likely to resolve in another short-term up leg, and then perhaps we can see, another short-term down leg, and then perhaps we can see the continuation of the medium-term uptrend. But short-term, it looks to me as if further euro-dollar weakness is likely to be seen on the back of that stronger US dollar. Now, moving on to the British pound, what we can see here is that despite stronger UK consumer confidence data coming out earlier today, the British pound is sliding versus the US dollar on that stronger US dollar on the back of hawkish comments coming out from the US Fed's president from Cleveland, for example, President Loretta Mester, and also the Philadelphia Fed Bank President Patrick Harper, both of whom said that they would expect and would like to have the Fed funds rate above the 5% mark in order to combat inflation. And with the Fed President Mester also saying that she expects the US to slide into a recession, albeit she expects to see a soft landing. But all of that is basically pushing the US dollar higher, and that has then led to the British pound against the US dollar sliding again back down towards this week's low at 123.54, and together with the 10th of April low at 123.45, it offers some pretty good support. If that were to be taken out, though, we would then be forming a minor head and shoulders pattern here, and that could then take us back down again towards the mid-February high at 122.70 and probably much lower than that. But we'll have to see whether that will actually happen or not, or whether the 123.54 to 123.45 support area is going to hold one more time. Provided it does, further sideways trading between these lows and the high we saw so far in April at 125.46 is likely to be seen with regards to cable. Now, moving on to the Japanese yen, what we've seen here is despite the stronger US dollar, the dollar yen rate did actually come off towards the midpoint here of the uptrend channel the currency pair has been trading in since the beginning of, or since late March, basically. And this was on the back of annual inflation in Japan sliding to 3.2% in March compared to its 3.3% reading in February. And basically this lower inflation reading, together with the Japanese manufacturing PMI, which rose to a 6-month high, helped the Japanese yen appreciate versus the US dollar and pushed the dollar yen exchange rate lower from its 135 yen and 13 sen high, which was made just earlier this week on Wednesday, close to the mid-March high at 135.11. So short term, we're seeing some downside consolidation here, but we remain with this uptrend channel, and basically, as long as we do so, it is likely to continue. So perhaps just a short-term blip with regards to the uptrend in case of dollar yen here, as you can see, still pointing up. Now, with growth fears lingering and the US dollar appreciating again, the price of some commodities like oil and also gold and silver have just topped out again. And if we begin by having a look at WTI, we can see here that we have basically not just failed recently at the 200-day simple moving average, the red line here, but also are currently in the process of closing our March to April price gap. And you may remember that gap was created when OPEC Plus over that weekend announced that it was going to cut its output by 1.16 million barrels a day from May onwards, leading to this huge jump in the price of WTI crude oil. But interestingly enough, and again, that's why I love technical analysis, is that we failed at the 200-day simple moving average, which is often the case, and then closed, or partially so far closed, our price gap. And price gaps, unless they are breakaway gaps at the beginning of a trend, so a breakaway gap is sort of at the very beginning, a very strong uptrend, but these are quite rare. Unless they're breakaway gaps, they tend to get filled. And this is exactly what's happening at the moment. As I said, the fundamental background is that the demand for oil might diminish if we were to head into a recession. And here, from a technical perspective, the reason is basically the closure of the gap. So the gap goes down to the late March high at $75.76. We have so far slid to $76.71. So we are only about $1 or so away of closing that price gap. And once it has been closed, the upside may once again take over. But short term, it looks as if further downside to close that price gap is likely to be seen. Now, the stronger dollar has also had a negative impact on the price of gold. The precious metal here having risen last week to a one-year high, $2,048 per troy ounce, has now come off, and this week briefly dipped to 1,970, difficult to say, dollars per troy ounce, but did not close below the previous support line, an area which I mentioned over the last few weeks, between the 10th and the 17th of April lows, and both of these came in at $1,982. So we haven't closed below that level yet on a daily chart closing basis, but heading back down there again today on the daily financial bet of the gold price here, as you can see. And if we were to close below 1,982, it's likely that we would also fall through 1,970 and head back down again towards the February high at 1,959. And we've also got some pretty good support going all the way down towards sort of 1,947, the late March and early April lows. So that is what I expect the price of gold to do from a technical perspective for the next few days, provided we stay on a daily chart closing basis below yesterday's high at $2,012 per troy ounce. And let's just finish up on the price of silver, because as you can see here, silver had a very sharp ascent from below the $20 mark, as you can see here. I'm just trying to see by how much silver rose, because I believe it was by 30%, but I just want to make sure it is actually. Yes, by close. Right now, we're just consolidating below that $26.09 high, and so far have tested the low from Wednesday at $24.65. And provided we stay above there, further upside may be seen. But if a fall through the $24.65 mark and also the highs seen at $24.63 seen back in February were to happen, then I expect a top to have formed here with regards to the price of silver, which would then take us probably back into the middle of this sideways trading range we saw between December and February of this year, around the $24 mark. Thank you very much for watching Charting Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.